All right, cool. So yeah, I got the article up. I read it. How did you guys what was the impetus for this? Why did you want to talk about this article in particular?
So I thought that this was a pretty interesting article, um, especially for capital consumption theory. And there's like it's a very good thing to look at some nuance, like with what Stephanie Kelton is thinking and what capital consumption theory would say, which is different.
Yeah, there's
Um,
also and also what consumer monetary theory would say, which
and
is also
and what
different.
CMT would say. Yep,
Yeah.
absolutely.
Um, so I want to make sure. So this was actually didn't. That's funny because the article that I read before, I didn't think was Stephanie Kelton's article. Did you send me a different one
I'm pretty
on
sure I
Facebook?
sent you this one. Yeah.
That's interesting. So okay, no, I guess this was it. Let me check, make sure I read the right article.
Did you just not recognize it as Stephanie Kelton in the body of the text?
Well, I just remember checking and then reading because it sounded very much like her, but then the name was some guy I couldn't remember. But I must have been on the wrong article. Let's see. Questions: How would we pay for it? Bureau Transportation. Most recently, yeah, no, okay. I read this one. Yeah, so I thought it was very MMT-ish, and I was like, oh, I thought it was interesting that someone at the New York Times was writing in an MMT-ish way. No, it turns out it's just Stephanie Gilton again. Um, yeah, okay, cool. Yeah, was there anything surprising in this to you? I mean, this to me is very much, uh, like this is sort of what I've come to expect
Right.
from this corner.
If there was
Okay.
anything that stood out to me, there were two things in it that I thought were more slightly more sophisticated and more interesting than you sometimes get in the pop culture version of the discussion, or the journalistic version of the discussion. The one was that she actually was saying, look, that we can overspend here. She was saying actually the deficit hawks aren't worried enough about spending because they're not worried in the right ways, right? So she says what she said. Normally, the MMT perspective is the one that says you should spend more, or that's been historically the case. MMT has said looking at capacity, right, or post Keynesians generally say looking at capacity, we could spend more, we should be spending more, right? And other people say no, 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 because we have to balance the budget, we can't spend. Now they're saying, don't worry, we're balancing the budget. We've got these taxes and other things that will pay for it. And MMT is saying, well, actually, no, you're still overspending because it doesn't matter if you cover it with taxes, because it's if you're throwing money at parts of the economy that can't handle that money, it won't matter that you're taking money out from somewhere else, right? And this is something I remember. I was talking to a friend of mine when I realized how quite different the sort of the soft money approach is to standard sort of progressive thinking, because he was talking about how how much we could spend on a basic income, and he was saying, well, if we taxed all this money from billionaires, we'd be able to spend more. And I'm like, well, actually, no, because money that's sitting in an offshore tax haven isn't active in our economy and isn't therefore causing inflation. What you have to worry about is the teachers' salaries, because when you pay teachers a salary that is active in our economy and it is putting, generating inflationary drag, if you will.
So there's
So
a
this article is interesting because she's saying, you guys, it's not just a matter of more or less. You guys are counting it in the wrong way, and
Yeah,
sometimes that will actually be a more
so,
austerian position than the deficit hawk
yeah,
position.
and
so
this.
there's a really
Go ahead.
great quote in the article about this. So I want to go to the quote and put that on the screen. So it's this one in here, and it says, but because these proposed hikes, we're talking about tax hikes on the wealthy here, fall exclusively on corporations and more affluent Americans who have a relatively higher marginal propensity to save rather than spend, the taxes may not diminish enough private sector spending to prevent the government's own increased outlays from igniting some inflationary overheating.
Right. Yes, that's right.
Yeah.
So, yeah.
And
Did,
this.
did you did you want to talk about it from CMT a little bit?
Well, I mean, I think that it's nice to see this in the New York Times. This isn't surprising coming from Stephanie Kelton, right? MMT has been very consistent, and I think they've, it's probably doesn't do them, it probably does them a disservice to say they're the ones who are normally in favor of spending. Very Kelton and to some extent Mosler have been very clear this whole time that yeah, you can't expect the taxes, to pay for the spending, and that it depends on how you tax and that sort of thing. I would say, yeah, the the issues, right, are that she's still sort of talking about imagining that tax is how we control this, how we control inflation, and then there's of course just the sense of what causes inflation, right, and what are actually um, what is it we have to worry about? I mean, those are all she's talking about, employment and all those things,
Because
but
the general idea is that inflation is caused by overrunning capacity, is I think the standard economic, and I think MMTers sort of agree with that. I
yeah,
think.
they do. That is a disadvantage of the status quo and MMT that they share. Yeah.
Does CMT have a different idea about inflation being caused by overrunning capacity or
Yes.
being caused by something different?
Oh, inflation occurs when increases in spending are not accompanied by an increase in goods, but that's not the same thing as the economy being at its capacity. If
This is
so,
where we need our 5
But
different definitions of capacity, and
not really. No.
where they go.
so,
Yeah,
so
yeah.
Derek, what
Like,
to clarify what you're saying, what is the difference between
let's not
um,
do this again.
capacity? What is the difference between capacity, say, as measured by capacity utilization, and what you have in mind when you say, in what situation would you not run up to a high capacity utilization, but yet
We're
somehow
not talking about
the economy would not be able to make, you
we're
know,
not.
uh, put out real goods as you
Let's
increase spending?
let's not get into a question of the capacity utilization statistic. That's not what this is about. The idea is just and I think on some level MMT would agree, and in the book so far, Stephanie Kelton has, I think, in one paragraph mentioned mentioned consumer goods, right? But the idea is that inflation is when you're not there's too much spending chasing too few goods. So that's all inflation is. That's pretty simple to understand. When you're hitting that level, it doesn't mean you're at the economy's maximum potential to produce more goods. It just means that your spending is overrunning goods that are being produced in the present moment. So you could better activate your capacity by changing the way you're spending. Um,
Right. So you're talking about this, sort of a more general, higher, larger idea about capacity, where you're including potentially changes to the economy, such as building up, such as maybe building more factories, which would allow you potentially to produce more goods, even though you can't necessarily produce more goods at the very moment.
no, that's not it. Because let me make it very clear. What I'm the difference that CMT is adding to the table, the important one, is that we're defining capacity in terms of consumer goods. And so, whereas Kelton is writing here thinking about the ability of the economy to absorb more employment. So and those aren't similar. And so I agree with you that like you have your fixed capacity. Then if you want more capacity, you can add factories. You can do all these different things. But if you have all this, if you let's say that you've decided to throw tons and tons of spending into employing people for not really in a useful way, you're definitely not at the limits of your economy to absorb more consumer spending because you haven't even tried to increase consumer spending. If you just increase consumer spending, you would find, oh, it would be okay, right? So yeah, you just want to make sure that um, that we keep those things clear, that we're talking about what is the economy's potential to produce consumer goods.
Right. You're basically pointing out that if you fail to distinguish between the production of consumer goods and the employment of people, and then you try to like um, throw all the stimulus or all the money into employing more people, um, I think you're saying that potentially you could actually get labor costs rising, um, even without being effective at making more goods.
Well, I don't know where labor cost comes
Something like
into it.
that.
Labor cost, you don't need to bring it in. But the point is just that um, if you're muddling, you have to be really clear what kind of capacity you're talking about, because yeah, you could put in employment and government
I
programs
think
and all this stuff, and you could ramp all that up, and then sure, you would not be at the consumer economy's capacity, but you would be at the economy's capacity to absorb more of to do more of this stuff that you're getting it to do. Yeah.
More right.
I think
So
it's
the labor
problem.
labor is different than goods production. There's a
Yeah.
there's a difference. Yeah.
That's all.
Yeah. This in this article, she's quite clear that she's not when she's talking about running into an inflationary blockage. It's not about hitting full employment, right? She says, no one can tell where the shortages are going to if we sort of rush into all this spending. without considering the economy's capacity to absorb that spending, we
Right.
could hit inflation.
Right.
And because what the government has done is instead is looked at the budgetary so the balance of taxes and spending, and does the government have enough revenue to cover this, or are we going to be running a large deficit, which is a sort of a bad heuristic for whether or not you're going to overrun the economy's capacity. I think
Yeah, she's right about
Kelton
that.
would be quite sympathetic to Eddie's approach of actually going to factories and asking, how many more face masks could you manufacture or whatever, as at least as a sort of starting point for understanding where there's capacity in the economy and where you can spend without
She does
hitting one
imply
of the
that.
bottlenecks.
She does imply that in the article towards the end, yeah. But I find it kind of weak. Like I don't think that um she's suggesting a lot of different things here. Some of them are really powerful and important, like this whole idea that we need to budget differently, we need to balance the economy, we should not be worrying about the tax revenue. You know that's not going to affect it either way. It doesn't necessarily affect it. It doesn't get you what you want. But then she ends it with a bunch of questions like the idea that, well, in order to make sure we don't prevent inflation, what the government should do is sort of like create this census of, you know, how are our railways doing, and you know what's the drinking water like, and the broadband, and like how much steel and concrete and fiber optic do we need to put all to do all this. And that's not at all, those aren't the questions that you want the
I also think
government.
that's a
I
fair
think
point.
You don't want the
they
government
relate.
to be doing that when you're talking about inflation. You do want to do that when you're designing a program, you know, to create these things. But it's not.
No.
But inflation is
Yeah,
something much broader than that. You know.
let me talk about the
Actually,
CCT view
sorry.
a little bit first,
Yeah.
because the CCT view actually comes to like almost opposite conclusions from what Stephanie Kilton is saying here. So to understand the CCT view, you have to understand that from the CCT view, we have to distinguish two things here. So one thing is the economy, and the CCT view that is that there is underspending in the economy. You need to bring spending up in the economy. Capacity utilization is way too low. On the other hand, you have the government, and the government finances are actually a little bit. They're actually a little bit stretched. They're actually a little bit overstretched, and the CCT view does say that because your currency is is something that that gains its value on the market. Like people are willing to hold it or they're not willing to hold it. You actually do have to worry about, um, especially with the excess stagnant idle capital at the top of the economy. What you have to worry about is an unstable capital flow going out of the currency and causing the currency to crash. And generally, causing the currency crash actually causes the economy to crash also. So if you look at the hyperinflationary scenarios, generally what happens is that as you get inflation and as the currency value goes down, um, businesses tend to get very worried about accepting money, and so they tend to raise their prices to kind of counteract that. But they tend to actually go too high. They don't know how much the prices really should be, and they go too high. So as a result, you actually get this money supply, which is increasing in nominal terms, but the real money supply is actually decreasing in real terms because the prices are actually rising faster, and so you get like super stagflation, and you get a contraction of the economy at the same time that the currency is getting getting crushed. So where Stephanie Kelton is saying, you should you might want to, it doesn't like it doesn't work, it's not necessarily a good thing to tax the rich. Like she's basically saying that you have to worry about the spending. I would say the opposite. Looking at capacity utilization, which is at 70%, it's century lows. You have way too little spending in the economy. You want more spending in the economy, no matter how you get it. And the danger from inflation, and another thing that people don't manage to separate most of the time, is that we are not in danger of capacity constrained inflation right now. We're not in a situation where spending is going to rise so much that everybody that owns a factory is going to be, completely full out the way they were sort of in the 70s, and they start raising their prices because they can't actually produce more. They can produce way more right now. You're not going to get that, but the danger is actually in getting a unstable capital flow out of the currency, and that is especially dangerous in this type of scenario, as it was in Weimar, as it was in Zimbabwe, because um, you have large pools of excess idle capital. Like stock market yields are really low, bond yields are really low, rental yields are really low. You have what Ray Dalio calls an everything bubble, where the entire financial sector has an enormous inflated value,
Yeah,
including Bitcoin, and they're not actually earning money with that value. So it's not stable. It's not a stable investment the way a factory is stable. Because once you invest in a factory,
I don't.
the factory provides income, which justifies itself, and it's not going to be going anywhere.
It's a lot of different things. Some of them have to do with have some of them follow, some of them don't. Hmm. Where do we begin with that? Uh,
Let's circle back for a second here, guys. Back to the article because there's two parts, right?
yeah.
I don't think I
I
think you
just
got a little in the way there. But in terms of the broad picture, I don't think it's that what Eddie's saying is that different to what Stephanie Kelton is saying.
Eddie said something very
What she's
different.
saying is,
Eddie's
I think
talking
the
about
downside
Eddie
of
is
So
talking about
Stephanie,
a flee from the currency,
right? So
driven by accumulated capital of rich people who are afraid of the
right.
currency inflating. And I'm not concerned about that. Stephanie Kelton's not concerned about that.
So right.
Altella
So
isn't concerned about
put it
that.
in a nutshell,
is concerned
Kelton
about
is saying
inflation.
right. Kelton is
And
saying
Not
that
the
you
kind
don't
Eddie's talking about. Eddie's not talking
right.
about the kind of inflation that we're
Right.
talking about. He has a whole other
So
thing.
Kelton is saying that you don't need to pull money out away from the wealthy, um, because pulling money away from the wealthy is not effective because they don't tend to spend their money.
Yes,
And I agree that they don't tend to spend their money. But I'm saying the opposite thing, that she's saying she's worrying. She's basically worried about capacity constraint inflation, and I'm arguing that that is the wrong worry in this era. We're nowhere near capacity constraints, and
I agree with
worrying
you.
about capacity constraints actually gives you the exact wrong answer. Because if you were at capacity constraints, then you would have to worry about it the way Kelton is talking about, like, oh, you don't want more spending. You actually have to draw spending back a little bit to get back under capacity. But I'm saying that's not a worry, which I think Derek agrees, and I'm saying that the worry, which Derek is not convinced about, but which I'm saying this is what we should be worried about, is the hyperinflation Weimar Zimbabwe type, where you have all that excess idle capital, and it is in investments that don't make sense in a normal sense, like stocks,
Hmm.
the everything bubble, stocks, real estate, Bitcoin, NFTs, all of that. Everything is going up and up and up against the dollar. And the worry is that at some point people start worrying
Yes.
about the dollar, and when
Uh,
they and usually you get a small crash in assets, but they don't. But the people crashing
yeah.
out of the assets don't want to be in the dollar either, and you end up getting
Well,
spending, because suddenly
before we
prices
make
crash down.
the jump to people fleeing the dollar in this hypothetical scenario, let's just understand that this bubble that you're talking about, and whoever's
Yeah,
watching a recording, I apologize if there's that echo. But Eddie, you could try muting yourself when you're not talking. That sometimes helps. But
right. Derek, you are recording this, yeah?
yes, I am.
Okay.
But um, the 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 bubble that's being grown here, that's a policy decision, and that doesn't just happen sort of magically. The central banks will have to do that, and have been sort of doing that as normal. That's sort of what we consider normal, is to do this, to float the economy on all of that stuff. And in the absence of the consumer income that's going to help us sort out the productive from the non-productive investments, like, I agree with you that would be preferable, but it doesn't, if you blow up that bubble for a very long time, that doesn't sort of somehow, that doesn't cause a fleeing of the currency, because they're growing that bubble. That's how we currently achieve price stability, by blowing up the private financial sector. And if there's a big pop and people realize, oh, it's all worthless, well, we know what happens. We saw that happen before. We've seen that happen many times in history. There's a big crash, which is not really what happens when you're worried about, like, oh no, inflation, the prices are soaring, and the profit spending is causing people to flee the currency. No, like the whole thing contracts. The whole thing contracts when the bubble gets too big. That's
Right.
If the bubble's just getting bigger and it's not popping, then everyone just goes on like life is normal. They don't see it's a bubble yet, right?
I would
So
argue that we do see, bubbles that crash and bring down the currency. Not all the time, but we do see cases of that in history. So it's not that the Fed is purposefully trying to create this bubble.
right,
So I would go a little bit.
they just have to
I
do
would
it.
talk again about, like we've talked before, about the airliner analogy, where you have limited seats on the airliner. You're issuing tickets, but I would describe the current situation that money supply's up, money velocity is down. You've got a lot of tickets out there, but people are not spending them. So right now, you don't see inflation. But the trouble is that if people, begin to worry about the value of the tickets and they want to convert out of the ticket, then suddenly everybody you have a rush for the seats and you get inflation
Right. No,
suddenly rather
no.
than gradually.
No, if
Rather than
there's a rush
gradually.
for the seats, then whoever is in charge of controlling the price level will use discipline. Will react with discipline
Right.
to
So the
to
Federal
bring
Reserve
spending down.
could start to
So
right. So the
notice,
Federal Reserve could raise interest rates and they could
yes,
contract the money supply
they
that way.
could do a
That's
lot
what
of
you're
other
talking about.
things too. Yeah, but they're going to contract. They're going to
That's the
contract.
main.
They're going to contract spending. Now they're going to do that by
But they
changing
don't.
interest
They don't have
rates.
their hands on spending right directly. All they can do is the interest rates and the QE. They're it's indirect. They can only issue the tickets or like call some of them back in. But they cannot directly direct all of the people who have dollars
Yeah, but
to spend the
they've never
dollars
been
for
able to
us.
do that. No one will ever be able to do that, and that's fine. So it's
And that's
similar.
that's where the well, that's where the danger is. The danger is that you know on the way up, you're being helped out. That the Federal Reserve is pushing all this money supply out, but you're kind of being helped out that you're not getting inflation because the money supply is not getting spent. You're not getting money velocity.
Is that
But that's a
does that
double-edged
help
sword
though?
because
Because they're
on the
trying
way up,
to.
like you hold on, let me just finish this and then
Yeah.
and I'll let Austin talk. It's a double-edged sword because on the way up, as the money supply expands, you don't get inflation. But on the other hand, on the way down, what you end up is getting all of the problem concentrated at once. And generally, that is a situation that the Fed is very ineffective at fixing. For instance, if they raise interest rates, you can raise interest rates to like 10%, 20% a year. But if your currency is inflating at like 2% a month, which or 5% a month, which annualizes to 60% or more, like the inflation can go much, much faster than the interest rates can go up. If you look at historic examples, that is the type of thing that you see happening. Yeah.
Can I jump
Well,
in? Can I jump in
Yes,
for a little
something to
while?
go
say.
ahead, Austin.
Yeah, look, there's. I want to quickly touch on the second part of the article, then I want to come back to this because it's relevant. Like the first part of the article is about how we would hit inflation by spending in the economy in a way that doesn't account for bottlenecks and stuff like that. And I do think that looking at railroads and supply infrastructure matters in that regard, right? Like ports and so on. And the second part is she says that this is so we should not be thinking too much in terms of buy American. And like
Yeah.
that the Biden plan by not using the excess capacity that's out there in the world, it's making the job harder for itself.
Yes.
And I think that's those are both things that I would agree with, right? And I also don't think that I think Stephanie Kelton's assuming there's a degree of potential chaos out there in the marketplace, and what she's saying is, careful, if you step on a landmine, it could blow up.
Yes, but
like if we hit a small bottleneck, it may trigger runaway. She doesn't get into why, but I'm not sure that the mechanism of how she or others like her would see that playing out is that different to what Derek's saying. And I just want to address what Derek.
yeah, they are
Sorry,
similar, and I have problems with both of them. Right.
So I mean,
This
it seems to me that you've got you're saying, well, there's what's happening in the financial markets over here, and then there's the sort of consumer economy over here, and the links between them aren't that strong, right? And what's happened, all the money sloshing around in the financial sector doesn't pose a threat to the stability of the consumer economy because they're not, all those CEOs with $1 billion aren't going and buying $1 billion worth of pizza. Is that more or less
no.
my understanding? Well, let me finish how I see it anyhow. I basically see those two things fairly disconnected, but
Right.
the one place that they definitely connect is real estate, and another is commodities. And what we could see is if there's a little bit of inflation, like Joe Biden tries to spend in a way that produces a bottleneck, and the price of whatever, I don't know, cotton, fuel, steel, whatever the item is, goes up. That starts to register in inflation. People get worried about the central bank raising rates, which is the discipline that you just discussed, and they look
People are worried
somewhere else
about
to
it.
put their money outside of, and they need, how do we get out of the everything bubble? And where they go is commodities, because they're like, well, if people are actually spending money, let's be the ones, let them move over to copper, steel, blah blah blah, and then that in fact in turn increases inflationary pressure, and that's when you get your runaway train of inflation, because the more inflation you get, the more the central bank tightens, the more people are like, shit, these assets aren't worth it. And
Yeah,
they look for somewhere to go, and
the
commodities come into fashion,
the more the
right?
central bank
And
tightens,
then we're in trouble.
the more the central bank tightens, the less money people have in general, the less spending people are doing, the less businesses are opening, and so you are not in a scenario where so people are worried. Investors and people in markets and the financial markets will worry about the Fed raising rates and don't like it, and are upset when it happens. That doesn't mean there's going to be inflation. It means that we're going to have a cold period. We're all gonna have to tighten our belts like we did after the Volcker shock, right? And people will get a complaint about it. People will be very upset. And that's exactly how we will not get inflation. So what Stephanie Kelton is missing, and I think maybe what Eddie is not missing, but maybe not emphasizing enough, is that when Stephanie is saying about how okay, there's going to be this, maybe there's a little bit of inflation, but then yeah, you can step on this landmine if we're these bottlenecks, and you could trigger getting run away. Well, remember that Stephanie Kelton she doesn't talk about it in this article, but she's advocating for a particular fiscal policy to control the inflation rate. And she's disallowed herself. Yes, and she's disallowed
Yeah,
herself.
well, I like that this article doesn't bring it up, right? Like that was one of the
Yes,
reasons I like this article,
but
because you can address just the argument she's made rather than where we think that's
no,
going.
no,
You know,
no.
next time.
Forget the federal jobs security because that doesn't matter. Because what it does matter is that she's not thinking about monetary policy. So they've taken that off the books because they want to say later, forget monetary policy. We'll just do the FJG, right? So she's acting in a world. She's written this, and notice how she's not talking about. So instead of saying, oh well, their government spending will by buying up all these resources that Biden wants to buy, do all these things, right, and possibly in efficient ways, that's going she's not saying oh that's going to cause central bank to raise rates instead of us getting inflation and then the market will suffer, which is what she could be saying, and that would be an accurate thing to say about a problem that we could have with sort of uncareful government spending, right? That would be a real problem if the government is taking all these resources, not using them super efficiently. The market's going to suffer, the private sector market will suffer, right? But as a consequence of us keeping that inflation rate stable. Well, as a consequence of the resources being taken, but as a byproduct of that, because we have a price stability mandate, there won't be inflation, right? So there'll be suffering in the private sector, but not inflation. And Kelton doesn't mention that.
Let me pose a monetary policy question to you.
Sure.
So we're in this hypothetical, and I want to emphasize that I'm not saying that this is guaranteed, like where we're going. I just want to say that there is a significant risk. So we definitely should be kind of trying to tone down on that risk and not make it worse. But the monetary policy I'd like to pose is that in this hypothetical, say it's 2 years down the road, the asset inflation has continued, so everything's crazy expensive, and we're also starting to get a little bit
What
of
asset inflation?
inflation.
Are you talking about housing?
That Bitcoin, real estate, stocks, and
I
bonds.
Why do we care about stocks and bonds? I mean, real estate we can have a conversation about, but people
Right.
throw
So
out this word asset inflation.
Yep.
But remember,
Yep.
inflation is measured in consumer goods.
No,
Where no, we
right,
don't
right.
we
So
don't care
asset
about
inflation
inflation in
is
Bitcoin.
not goods inflation.
We don't
So
care.
asset
We don't
inflation
care about that
is
at all.
not goods
Do you
inflation.
care about?
So
Oh, sorry, guys.
hold on. Let me pose this. Let me pose this question because it tells you, because it is a question that maybe you should care about. So
Yeah.
So the real estate and the stocks and the Bitcoin, those are definitely not raising the cost of people's meals directly or anything like that. So I understand what Derek says, that we don't care because it's not goods inflation. So in our hypothetical, 2 years down the road, this has gone on. Everything's really all the financial assets are really expensive. Inflation is starting to tick up, and people are getting a little bit worried. So the Bitcoin and the stocks and and everything crashes a little bit. And with the inflation, people are also, withdrawing from treasury bonds. They're withdrawing from treasury bonds. They don't want to buy bonds because they're worried about the value of the dollar with inflation. As people get out of the bonds, one of two things is going to happen. Either because of the lack of demand for bonds and because of the government deficits, you're going to get interest rates going way up, or the Federal Reserve will, buy the bonds instead and print money to provide the demand for bonds, which would prevent the interest rate from going up. So that is a sort of it's sort of like Scylla and Charybdis. Like there's it's two things where the Federal Reserve is going to be stuck. But I'll pose a question to you: if you're the Federal Reserve, 2 years down the road, people are getting out of treasuries. Do you keep the interest rates down by printing more money to buy the bonds, or do you let them rise?
People are getting out of treasuries because there's been inflation.
Yeah, because there's been inflation and they're worried about more inflation, so they don't want to be holding a treasury bond which promises to return your money like 20 years down the road, or 10 years down the road, or even 5 years down the road, where it's going to it's a
They're
nominal
exiting
thing.
to a different currency. They want returns in a different currency than U.S. dollars, is what you're saying.
There's many
So,
different things they could do, but
well,
for
that's what you're
instance,
implying. That's what you're implying, right? Or correct
well,
me
I'm
if I'm
not
wrong.
implying anything specific about what they're buying. Like they could buy many things, like another currency or gold or lots of different stuff. But I'm only saying that they're getting out of the bonds for sure. But the first thing that they do, they don't sell the bonds directly for like gold or something. They just sell the bonds for dollars, which they're going to then go and use to buy gold or
They're
do
going to
something else.
sell the bonds for dollars to buy gold to get away from
Yeah.
U.S. dollars.
Right. On the market,
Look,
there's a market
if
for
no one,
bonds where
if
you can
there's no
sell
market,
your
if there's no market for U.S. government bonds, you
Yep.
don't have monetary policy. So my recommendation, and what the central bank already does,
Well, you don't.
is they don't let inflation get so high that people start considering exiting U.S. dollars and wanting to collect money to spend at
But
goods
but right now
available in
they're
a different
trying
economy, right?
they're
So
trying to
so
push it up. So
it's
maybe they're successful and it's up to like 5%. But then people are getting worried and they're getting out of bonds.
yeah, and they raise the
So
rates.
do they? So I would suspect that you would lean towards like let the rates rise. Don't buy the bonds. Let the rates rise.
Don't buy the bonds, let the rates rise. Go ahead, Austin.
I think what Derek said was if there's no market for U.S. bonds, you don't have monetary policy, right? It's like yeah, and that's the worst case scenario.
Right.
That's the hell on earth. That in a sense, that's when monetary policy breaks down. That's the ultimate crisis of
Right,
either
Yeah.
inflation.
So it's
like,
just fresh.
there's no monetary
Let me-
policy. That's a little bit too broad. Like, what happens in the real world? I mean,
Yeah,
the Federal Reserve doesn't
I think
like
we need.
poof
I think
disappear.
we need to go broad. I think we need to go broad
They-
because, like, okay, so you guys both know the three-body problem, right? I've heard
The
of the
what?
three-body problem.
Remind me.
Three-body
Oh,
problem.
three body problem. Yeah. No, I'm familiar with
So
the
in
three body
physics,
problem.
if
Dynamical
we have
systems. I love it.
Yeah, exactly. If we have two objects with Newtonian physics, we can calculate how they're going to orbit forever perfectly. Right? You add just a third object, and the number of calculations required to have an accurate prediction becomes infinite. And of course, in the real universe, there's many more than three objects. And this is a bit like that, guys. Like this, I think. And what is common about all these different perspectives, which actually have quite similar overall roots, is that we're all saying, well, we're approaching this. I mean, what I think Kelton and Eddie and me are thinking is we're approaching this point at which chaos takes over potentially. We're approaching this point at which things become extremely unpredictable. And I think, Derek, what the difference is you're doing what I think is called a little bit is called equilibrium thinking. You're assuming that like it's a self-balancing
I agree
system.
with this. Yeah.
No.
When the price level starts to go up, we raise interest rates, it goes down. It's a little bit too easy, and I don't think. And I mean,
Yeah.
for me,
So,
Look, listen. I'm not saying the market solves
Let me
itself.
finish. Let
Yeah.
me finish. Right? We were talking about where does the money run to, right? And I don't care where it goes, unless if it's just rich people losing money, great, right? Whereas if they then because some of the money starts to get sucked out by increased interest payments. Right? But the people who are still a little bit ahead of the hammer, the people who aren't like bankrupt and just having to sell their stocks yet, right? Or even who are just about at that point, say they don't want to be in a falling market, they want to be in a rising market. If it looks like inflation's happening and people are moving to commodities, they'll go there because then they'll be able to stay ahead of the interest payments as long as if the commodity prices, for example, rise enough. And there's this huge amount of money sloshing around, it goes to commodities, specifically the stuff that actually goes into consumer goods. Right, and then that's how I see an inflationary spiral kicking off. That's not driven by consumer demand as much; it's driven by input prices, right? Because the commodities are inputs. Commodities are where the financial market and the real world economy, speculation and consumption intersect.
Can I just? Let's try to get agreement. Let's try to get agreement because
I don't think. Let me throw out one more question to make it worse before we
no.
get the agreement.
Okay, fine,
So,
fine. You can make it worse once. Then we got to simplify this.
Which they ran into with Weimar, is that as this is happening, they're starting to get inflation. The economy is actually bad. Unemployment is actually bad. The bottom 20%, 50% are angry and in the streets and threatening to have a revolution or something. And so the central bank is looking at, okay, if we tighten rates, it's going to cause the economy to contract. You're going to get more unemployment. It's going to get much worse. and they were like, this is, we just can't do that. We don't like inflation, but we have no choice. We cannot contract the economy, so we're going to keep the rates down, keep the printing up, and let the currency rise.
That would be bad
And
policy.
that's another like skill of interruptus, where it appears if you don't understand the mechanisms correctly, then you end up like the Central Bank of Germany saying there's no good answer, but this is what we're going to have to do, which is going to actually make it worse.
I just say I don't like the Weimar or Zimbabwe comparisons at all, and because those I think are situations where
really different.
It's a political situation that's destroying the economy, and I mean you have that now in places like Lebanon. But I don't think that's the situation in the US. But I do see the possibility for something like what happened in Australia in the 90s, where we went from soaring house prices to crashing house prices, from low inflation to extremely high inflation, and interest rates go up to 17%. That was the
right, which is what we could be having that conversation. By the way, Austin, like that's what I'm suggesting we should be talking about.
So I would question, what are the difference economically? There's definitely going to be political differences, but economically, what are the differences?
Between Weimar Germany and Zimbabwe and the United States of America in 2020.
Yeah, there are going to be some differences.
There's a few differences there, right? So we're now in a situation where we've lost a world war, and we're now being sort of carved up by the other powerful nations, and they've given us sort of these set limits on what we can and can't do, and they're in a position to do that.
Demanding payments of debts in yuan and euro.
Right.
Yeah.
So they are demanding the government spend a lot of money.
If you're worried about that,
we don't have anyone else demanding us spend a lot of money, but we are spending a lot of money nevertheless. We have huge budget deficits, even though we don't have reparation.
Yeah. See, I think you're starting to see maybe Austin where his analogy is bringing down here. So look, this is how I want to simplify. I think this will be helpful here, right? Because this is where I want to get agreement on. When you start making these predictions, notice how you're making assumptions about what the government does or does not do, what the central bank does or does not do. Oh, they're worried about employment. They've decided they're going to double down on that and let the inflation rate go high, right? So, I just like to I just like to simplify this and say, okay, well, there's two basic ways the money can enter the economy: through the private financial sector or from the government directly. So if you're worried about inflation, which is just excessive spending, right? It doesn't mean we're at capacity, but the spending is too excessive. The spending is too excessive.
It's not necessarily excessive spending. It can be loss of faith despite still not having enough spending. And you can still have loss of faith. Or you can have like unstable spending. Like it spikes up suddenly just because everyone's, getting out of the country.
Are you saying...
But it's like low before and then suddenly it spikes.
Are you saying...
And then it goes down again, actually.
Are you saying that if the inflation rate is at 6%, and if the central bank tightens, and the government begins decreasing the basic income lever, right, or decreasing the other spending that they're doing, and keeps going down, you're saying that the inflation rate can keep going like this? It can kind of go volatile, and it can just keep going up.
It can go volatile. You would have to, if in this, kind of bad scenario, the 6%, you want to look at it in terms of months, because things stop happening on the time scale of months instead of that. So it's like 0.5% a month. And then it starts going up, and then the central bank, kind of waffles about it. But let's say they've got Derek on their board, so Derek's smart. Derek tells them, raise the rates. Go ahead and let them rise. So the rates. So I would argue that in this situation, the rates. So the Federal Reserve, they stop supporting the bond prices. They let the rates rise. So the rates rise, but rising rates still does not attract people into bonds. They're still getting out. And inflation continues to rise as well. Like the high interest rates do not.
Why is it not? So it sounds to me like you're assuming the hyperinflation in your model of the cause of hyperinflation, which is frustrating. Yeah. So you're saying, the higher rates don't attract more savings. So what's wrong with U.S. dollars at this point?
They don't.
That increasing the rate of returns on the safest savings asset is not getting any takers, right? Like, is there something wrong with the U.S. dollar before this has begun? Like, is the dollar no longer a stable standard?
The dollar at this point,
a stable pricing standard.
People are worried that it is losing value. It's losing value. So it doesn't matter if you're going to put 10% interest rate on it. If the currency is depreciating by 10%, in 2 months.
What do you mean by losing value? Please define what you mean by losing value.
Losing value, as in prices are going up. and it's losing value against gold, Bitcoin, and another foreign exchange.
Wait a minute,
Some
wait a
currencies are
minute,
stronger than dollars
Eddie, wait a minute. If it's losing value
on the
against
market.
gold, is
Yep.
that is a healthy currency one that has a higher value than gold, or is it one that has a stable value with respect to consumer goods,
Well, it's
average
losing
consumer
value
prices?
against everything. Like housing is also going up, food prices. Like you're getting into consumer goods inflation. So goods inflation,
Yeah.
it's losing
A
value
little
against the
bit.
goods also, and it's also losing value against
Yeah, so you're in
everything
hyperinflation at
else.
this
Like
point, but we were
let's
talking
say
about
Swiss
what
francs.
happens before
See, a
you get to
capitalist doesn't want to be in the
hyperinflation.
dollars. They're going to get into the Swiss francs
Yeah,
or the
Eddie,
German marks or the Japanese yen
Eddie,
or
you
something like
can't
that.
get hyperinflation without passing through inflation. So you're assuming you're just living in hyperinflation world all the time. And I like to think about living in hyperinflation world and how awful that is. But you also have to examine how you get there, right? No one's look. Gold bugs have
Sure, you
for
do.
centuries. Gold
Totally,
bugs
yeah.
have been fretting about the U.S.
But
losing value.
inflation is where the Federal Reserve wants to go right now. And again, I'm not saying that this is guaranteed that you're going to get
Yeah, because they've been
hyperinflation.
underrunning
I'm
their
not going to
targets.
saying that it's going to happen right now. I think the soonest it happens is 2 years down the road. But
No, you're
the
not.
Federal
It's not.
Reserve wants to have some inflation above
Of
2%
course.
because it's been down so long. And there is an assumption here based on a default assumption that this is capacity constrained inflation and it's similar to the 70s, that it's going to slowly go up and that you're going to have 10 years to do something about it before it even hits like 8%. And I'm
Yeah,
saying that
you
it's
will.
not going to be a 10-year thing. If it happens at this point of time because of the enormous, excess idle capital, which you did not have in the 70s, if it happens, it'll be like, from here to point of no return in within a year, within 1 year.
I
Uh,
jump in?
yeah,
I jump
I'm
in?
not gonna. You
Can I
know.
jump in, please? I think there's
Go ahead, Austin.
there's a couple of things. One, let's be clear that we're all on the same page, along with Stephanie Kelton and everyone in heterodox economics, pretty much, that the general picture is actually deflationary. Right? That we've been the deflationary the economy's been in a deflationary stage, or
No.
interest rate inflation has
So
been
so I
falling.
agree with you. So Austin,
No,
I agree with you only by
right?
half. So I would say the bottom is deflationary, but the top is inflationary.
Can I
Yeah.
just?
Well, this hold on a sec. No, please.
Yeah.
This is where you've got this gulf between what's going on in the economy of the top 1%, really, or the 10%, the
Yeah.
economy of the people who watch Bloomberg all day, and day traders and so on, and the real world economy. And like I think Derek and me are both saying, well, we don't really care about what happens to stockbrokers, right? Like if the stock prices crash
That's
and some
fine.
guy in Wall
Right.
Street
And you
doesn't
don't
make
you
his
don't have to care, but if it takes the currency down and it works into goods
yeah, I
price
know, I know, I
inflation,
know.
then you start
But
caring.
like where it's something like I feel like this is what's going on. We're like 1 point something percent with U.S. inflation now. It's bumped up a little bit, right? And so in
Sure.
the U.S. you've got inflation that's come down from this super low to just less than 2%, which is the target, right? And Derek's saying you're describing what happens once it gets past 6%, right? And Derek's saying, well, how does it
That's
go
higher
from
than
one
that.
or two to six without the government stepping in and doing something, right? And I don't think it's likely that could happen, but I do think it's possible.
Sure.
And what I'm saying is that the commodities market is
So
one way I can imagine
yeah. So
that
so
I've thought
Austin,
of.
you're right.
Let
Right. The
me
commodities
keep going a little bit
could
longer,
could do it.
because the other thing was something else Derek said was, so what's wrong with the US dollar at this stage? And like, why don't people want to get in the US dollar? And this comes back to what actually happened in Zimbabwe and Weimar, which was deep political crisis. Now, that's not where the US is, but it's where the US could be. And in fact, you can see this is my nightmare scenario, right? And it involves a political element. Is what happens is inflation bumps up to 2.2%. Everyone's happy. Fed goes, great. We're going to make interest rates 1%, something crazy, which would have been very normal not that long ago, or quite low not that long ago, right? They put that up. That's enough to cause a crash. Asset prices, the Bitcoin, stocks, all these people get out of their leveraged investments. These prices start to crash, including housing, including people's 401ks. And then you have this middle class who have done the right thing and invested in housing, done the right thing, saved and invested in these assets, and played the game, right? As from their point of view, they they feel like, oh no, my nest egg is destroyed. That contributes to a deepening political crisis, as well as the commodities thing. And that's where I can see chaos getting bad enough.
Sure.
But I still think it's an outside
I
possibility.
I I, I just I just want to because you keep saying we're all in the same boat, so I just have to emphasize how I'm not in the boat with you guys. I'm getting further away the more. Let's talk. We're in different
Okay.
boats
So
because
let me
you're assuming guys are assuming making a lot of assumptions about the general price level, and you're sort of maybe I've heard maybe four different theories of the general price level assumed so far. You've got political crisis, right? Like that's what keeps prices stable is if there's no political crisis, right? Then there's this whole idea of people who have tons of savings, they can sort of decide if they're pushed or if they get anxious enough, they can flee into some other asset or commodities or currency, and that can cause inflation, right? So and then some occasionally I hear back to like, oh well, it's consumer spending versus consumer goods. And if this those are imbalanced, and if one of them is imbalanced, there's a problem. Well, that's what I would say. And you guys are more talking about like, well, if there's too much consumer spending or something, maybe that could be
so let me let
inflation. But
that's really good.
these are a lot of different things, and I would just say those are all like stories you can tell about a period in history that maybe led to people making bad decisions, whatever. But only one thing causes inflation in the consumer price index, the PC, whatever you want to call it, and that is when consumer spending is not matched with consumer goods specifically. So all these other things can be happening, and they can cause people to worry, and they can be factors, but ultimately it's how we respond to those things, and if so we have to respond to one of those two levers, like, oh well, we got to make sure that we either bring spending down or we got to stop this other spending we're doing that's going to allow goods to go up. But the whole point is that you just got to keep those in balance, and if you keep those in balance, then then I don't know what you guys are talking about, right?
So I understand where you're
Let
coming
me
from, Derek.
respond to this.
Let me
Let me
hold on.
respond to this.
Let me
Really quick.
respond
Really quick.
to
It'll
Derek,
be
and then
really quick.
what?
Be really quick response
Okay,
to
very
Derek. So
quick.
Derek, let's just say that tomorrow there's a panic in the markets, and everybody who's in Bitcoin, real estate, and Tesla stocks, right, decides that they don't want to be there anymore. They sell it and they start buying commodities, and the price of copper, the price of the stockpiles of grain, the price of the rare earth metals to go into phones, all
they
double.
plummet. They
How
plummet.
does that not have an effect
Wait,
on?
they double or they
How does that
plummet?
not have
They double is what
double?
Austin's saying. Yeah, because everybody's getting into the commodities
Oh, everyone's
because
going
everything else
into
Getting out of
way
commodities.
overvalued.
they're getting out of the asset classes that they're currently in, and they're moving into commodities because they're like, well, these have real world value. I don't want to be in this inflated financial sector. I want to get my money into something that has tangible value. A bit like how people think about real estate and gold, right? But then that extends beyond real estate and gold into gold, silver, then copper, right? From real estate to farmland to farming inputs,
Hogs.
where the
Yeah.
investment leads. That has to affect the consumer price, even though consumers haven't decided to
Yeah.
consume more.
So
Their incomes have
Okay.
yeah,
So there's
So I think
yeah.
of course. But how is that different from any other? How is that different from any other contributor to aggregate spending, right? Because remember, I was talking about aggregate spending has to lower, it's to keep the
You were
prices
talking
stable.
about consumer spending. You were talking about consumer spending. Specifically, you've defined that there's consumer spending is the only thing
Right.
that defines capacity. That government spending and speculation are not really in that picture. And say we've got all
No,
these
no, no.
different theories of what could cause inflation. It's like a lot, like it's a complicated problem. A lot of different the problem can creep into the system from a lot of different angles, right?
Austin is
And
saying this is how asset inflation becomes goods inflation is through the commodities market.
No, he told a story from my perspective. He told a story about how people all deciding to stop buying the kind of area useless stuff and start buying useful input goods. Well, if millions of people are suddenly do that all at once, that changes thousands of people spending billions of dollars. Yeah, that will change. That will change. That will change how easy it can be for the millionaires, the people below these billionaires, to also be doing that, right? And that's exactly what is going to be affected when the central bank is going to make it harder to borrow money to invest in these things, right? So so that's the question then is how many millionaires do you have to discourage from doing this to keep the price level stable? And we don't need to know we don't need to know the answer on that.
If they're doing it with net wealth.
Sorry,
if
what,
they're not
Austin?
doing it with borrowed capital, if it's net wealth that they're using, then the Federal Reserve has zero say in it. The Federal Reserve cannot say anything about them buying commodities with their own net wealth, which they have not borrowed.
Yeah, so there's there's the billionaires up there who putter around and do the billionaire things, and then there's the further down you go, you get more and more people. So there's a lot more millionaires who are also doing all that stuff and whose spending is influenced by their savings returns in their other investments, which is influenced by how cheaply they can borrow money, which is influenced by how cheaply their businesses that they own can borrow money. There's a lot of
time all of these things, the Fed policy and all these other markets flow on, and sounds like you're suggesting they're going to automatically correct, right? Like it sounds
No,
like you're sort of relying on like with a few gentle pokes, movements from the Fed, or like a couple of variables shifting in a sort of slightly in a technocratic way,
no, they could
it'll
be
all take care of
extreme. No, they
itself,
could be
right?
very extreme. They could be very extreme. And again,
Yeah,
like
and
we're
if there's
assuming
an
this is a
extreme,
horrible disaster, right? So rich people have gone in.
exactly, and if there's an extreme movement into the commodities market, by the time it all levels out, you're already going to have higher input prices for producers. Higher input prices for producers means that they have to pass that on to the consumer. So you do get a spike in consumer prices before any of these other effects can sort of catch up with that you're talking
So
about. And by
let me
then,
say my
that has further effects. And it's
That's
a
the
butterfly kind of
story.
swings in
That's
the
the story
anti.
you're telling. But how it works is that we don't allow that to occur. So
so
what you
let,
at some
let me
point in
say my
your
two cents.
story, there's a missing panel where there's with all those people at the Fed just kind of go like this and they just fall asleep. And I'm like, well,
Uh,
what? Well,
No,
okay. In the
let,
past,
yeah.
maybe they that was what
Yeah, no,
happened.
hold on a second. Let me tell you what happens then.
Yeah.
Then you've got a situation where you've had high price inflation, people's incomes haven't increased, people's capacity to consume has dropped because there's been this artificial spike in prices caused by inflation. The Fed comes in and raises interest rates. So now inflation, you have high inflation and high interest rates. Great. And then maybe after a while, the interest rates get up to 17%, like they did in Australia in the 1990s. Right? And that turns it around and you get rid of inflation. But like a lot of damage has
Are
been
you
done
are
by
you,
this.
are you assuming the government meanwhile is pumping in? Because if we're keeping government spending
So
constant and we just raise rates,
let me say
then
my
you
two
don't get to
things.
that scenario.
Let me say my two
Like
things.
you can make any assumption you want to cause
That is
hyperinflation, and I
fairly
agree with you.
possible.
Like if the government floods it, we could totally tomorrow. Biden could say, "I want 10 trillion tomorrow," and we could run out of room in monetary policy. And it's
So to
just
talk
it's
about
just important to notice that we're at the very 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 opposite end,
That's
very
that's
opposite
the
end of the
article.
spectrum.
That's what Stephanie.
so to talk about the
But yeah,
And
so
I don't
like
buy and I don't buy it because everything the central bank, all of the intellectual brain power has been in pushing in the exact opposite direction. So like even if we were to get to some point where we reversed up and then we found, oh crap, we brought it up to 10 and now we're not we're still getting inflation. Like I mean like there'd be room for them to reverse a lot of policies that they have to undo a lot of stuff they've like gotten really good at doing over the past 20, 30, 40
well,
years. They
they
know
got
how
to
to
figure
undo
out
it because they invented this stuff in the first place, right? So like
let,
they
let,
can undo all of that and make the market um it would not be hard for them to do that, I don't
you
think.
can't just unscramble the eggs, right? Like
You're
once
saying that,
things
but that's
get
an
messy.
analogy. You're not talking about technically
okay
how it works. Look,
okay
look. I
All
hate
right.
to break
I
it to you
mean,
guys,
you're
okay
saying stuff
but
too.
but
You're
the
saying stuff too, and you just kind of keep presenting what we're saying is a story, and what you're saying is like
the
the pure physics of real
the
economics
the
as
money
plotted
has to
down on the
come from
tablet
somewhere. The money has
by
to,
Derek
look
Goddard from
look.
Charlie Charlotte, right?
Markets
We've
need a
got to
lot of
wrap
money
up.
to work. Markets need a lot of money to work. It has to come from somewhere. We know where it comes from. It's not a
caveat
mystery. It's not a mystery.
yeah
It does not come from the rich people. I'm sorry, it just
well it's
doesn't.
in their hands
Stephanie
it's already out there
Stephanie
everyone's got
Kelton
like
says it,
the
and I
eggs
agree
on
with
that
her in the
on the
article
top
that they don't tend to spend that. So the bigger and more impressive a pile they collect, the less of that they're actually spending. So if you add up, if you go, it's just like how in a business, what's the best
I'm
way
not
for a
talking about them spending. I'm not talking about them spending it. We're talking about them behaving in an unconventional way for investors to behave. That some situation occurs and we've gone through various scenarios of what those situations could be, and the kind of thing Stephanie Kelton's talking about of throwing spending at the wrong part of the economy is one example of that, where all of a sudden these investors could en masse behave in a novel and damaging way, right? For example, investing in commodities, which I think is much more likely than a general flight of the currency to the euro or whatever. But and then yes, we're not saying that there'd be no response and there'd be nothing that the central bank could do about that, or that there'd be no correct fiscal policy to deal with that. We're just saying it's not guaranteed that all of those mechanisms work correctly. That there are scenarios where those containment strategies can be overrun, right? And we're
the Fed
imagining what they could be. And I've got to go, guys, right? So I've got to wrap up and get out of here.
let me
Do we
say a
do?
couple things that to wrap up. The Federal Reserve right now, they are already making sort of like two contradictory promises simultaneously. On the one hand, they're saying that they are going to support the economy, they're going to keep rates low, um, and on the other hand, they're also promising that they will stop inflation. And those, in a normal, like in the incorrect single dimension model that 90% of economists, including Kelton and the rest, are using, those are like in one dimension, but you actually have to split them out. From the top and the bottom, you do want to take money out of the top, and you do need to put it into the bottom. And the problem is that when you think about just money going in or out of the economy, then that is the problem, that you're putting money in the wrong space, so you get inflation, but there's not money where it needs to be, so you're also getting economic misery at the same time. So
I'll believe it when I see
that's
it.
my conclusion on
When
this.
we're looking at the 8% and we can't, oh no, we can't, do it, then I will absolutely eat my hat. But like I
If
guess,
it doesn't happen, that doesn't mean it wasn't possible.
well, I've never
Right?
said it's not
We're not
possible.
saying this is going
But
to happen.
well, yeah, but I've granted the possibility a long time ago. What you guys seem worried about this happening, and I'm trying to say, well, don't worry. Just make sure that we're talking about what policies we should pursue. Obviously, it's entirely possible. It's entirely possible that we'll abandon monetary policy tomorrow. We could just say we're not going to use it, and we'll just. And by the way, Stephanie Kelton is advocating for that, right? Stephanie Kelton is saying, I think we should just definitely not raise rates because that's going to cause inflation, right? Stephanie Kelton believes this, so I worry a little bit that you guys are picking that up a little bit from her. But like,
let's just respond to what's in the article, right? Like,
yeah.
And what we're trying to do is get a theoretical picture, and that includes understanding what's possible, and where there could be complications in a sort of tidy sort of clockwork system. You seem to be proposing about how, if there's inflation, the rates will go up, and that'll solve it. There's no problem, right? Like, how has there ever been a problem in the past, then, right? Like, how has it been so tricky for people in the past? Maybe you've got the perfect answer for that. That's not the system.
Well,
not how the
yeah, it was called the quantity theory of money.
They had the same. They had a similar system. They had similar ideas at the time, actually. If you study it, yeah. They had different words in some places, but many of it was much of it was similar. They had the expansionary versus contractionary, actions, and the question of
right. But they used to believe, for example, that like, oh well, if we want to support the economy because times are tough and there's deflation, they used to believe that, well, you should funnel more money to big savers because that's going to give them more cash to and they're the best investors and they're going to just pick the right market winners. And that turned out to be absolutely the opposite, right? The opposite was true.
Are you talking about the 20s or the 70s?
That's kind of what we're doing now.
The 20s.
With super low rates, right? Anyhow.
No.
Yeah,
no. We've reversed our thinking on that, and so we used to think, oh, give a bunch of money to rich people, and they'll spend it into the economy, and we'll get more spending. And then it was no, that's wrong. You're influencing them to save their money with the government instead of with other people, and then you cause this huge crash.
It still goes to the top. I would say it actually used to go to the bottom, but it definitely goes to the top right now. It's corporations that borrow all the money. It's not the average, like you and me, and an average Joe does not get access to billions of dollars of printed Fed money. Nobody's going to lend that to regular people. It gets lent to corporations.
Yeah, sure.
Yeah. And the fiscal policy, I'm not an expert on it, but there's a question that would pose, which is the fiscal policy. How much of it goes to the top, how much of it goes to the bottom, and there's some things that suggest to me that a little bit too much goes to the top through fiscal policy. Also, that's why you need UBA.
A lot's going to the. I guess I wouldn't say too much going to the top. I'm just saying not enough going to the bottom. When you can shovel money to the top, and I think like, if you just look at the periods of opulence we've had and lost over the centuries, and also the fact that during these horrible times, like, rich people have been okay. Like they've survived as a class, right? They didn't lose it all. They wrote it out just fine, and so
you don't have to worry about it.
Yeah, like you don't have to. I'm not worried about them. I am worried about
I'm not either.
the Zimbabwe Weimar hyperinflation scenario, but those are where those are pretty clear examples of where the failures at the currency issuer level, where the models there were not good.
I'm not worried about how they'll be, but I do think we do need to concern ourselves with what actions they will take, because they control large amounts of capital, including money and including assets. Yeah,
that's always true, even in CBI world.
Can I just sign off with this observation? What we do agree on, like, there's a lot of that we disagree on, but I think it's fair to say that we agree that if there's too much spending, there'll be inflation. Right? If there's not enough, there'll be deflation, right? And that the way to figure out if there's too much or not enough is not to look at whether you're running a deficit or a surplus in the federal government, right? So that is, I think, the key point the key thing that Kelton's putting forward in this article. And two, what goes along with that, if you're approaching national capacity, it's fine to buy from overseas, right? And all of this, you don't want to over pressurize parts of your economy. But if you're not thinking in terms of, it's funny, economists always say money doesn't matter, it's only the real goods that matter. And here you're seeing that actually Stephanie Kelton's saying no, MMT and post Keynesian heterodox thinking is actually the one that's coming good on that promise and saying to determine our spending, society-wide spending based on availability. And that, I think we can all get on board with that, and still remember that we're in a minority that frame it that way in so many words, in simple language like that. And we're in that minority with Kelton and a lot of other people who we disagree with about the finer points, including you guys, and us.
There's similarities, yeah.
I'm going to bounce. You guys can continue.
Well,
nice talking with you.
We had a great chat. Opened up a lot of questions. I think we just close out the chat, and if you guys want to, we can always follow this up.
Yeah, for sure.
I think it's a good stopping point.